Good evening. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a major financial story that's rippling through global markets and has particular resonance here in Kenya, where banking and investment are pillars of our growing economy. Tonight, we're examining the surprising market reaction to a massive banking deal in the United Kingdom. NatWest, one of Britain's largest and most historic banks, just announced a blockbuster acquisition worth $3.7 billion. But instead of celebrating, investors sent the bank's shares tumbling. Why? And what does this tell us about the state of global finance, the pressures on traditional banks, and the strategies they're employing to survive? This is a 12-minute deep dive into the numbers, the strategy, and the high-stakes gamble that is reshaping a financial institution. We'll also connect these global moves to local realities, examining how similar pressures and strategies might play out in the Kenyan and broader African financial landscape. Let's begin with the headline that shook London's financial district this morning. NatWest shares fell sharply, dropping by 4% in early European trading, following the announcement of its £2.7 billion deal to acquire one of the UK's largest wealth managers. This immediate negative reaction from the market is our first clue that this so-called strategic move is being viewed with deep skepticism. To understand why, we need to peel back the layers. First, the deal itself. NatWest, a bank with roots stretching back centuries, is paying a hefty sum to buy a major player in wealth management. The CEO, Paul Thwaite, framed this as a necessary evolution. He stated the merger will deliver, and I quote, "the scale and capabilities needed to succeed in a market with significant growth potential." On the surface, it makes sense. Traditional banking, taking deposits and making loans, is a low-margin, highly competitive business. Wealth management, on the other hand, involves managing the assets of wealthy individuals and families, earning fees that are often more lucrative and stable. It's a pivot towards a more premium, service-oriented business model. But the market's 4% sell-off screams a different story. Investors are clearly worried. They're asking, is NatWest overpaying? Is this a desperate move by a legacy bank trying to buy growth rather than organically build it? And crucially, is this the best use of £2.7 billion of shareholder capital? To debate this, let's bring in our perspectives. On one side, the bullish case for the deal. Proponents argue that in today's financial world, size and diversification are everything. NatWest, despite being a giant, is heavily exposed to the UK's domestic economy. By acquiring a large wealth manager, it instantly gains a new revenue stream that is less tied to the boom and bust cycles of high street lending. Wealth management assets under management generate recurring fees. This could smooth out earnings and make the bank more resilient during economic downturns. Furthermore, they have a massive existing customer base of over 20 million clients across its NatWest, Royal Bank of Scotland, and Ulster Bank brands. The cross-selling potential is enormous. They can now offer private banking and investment services to their affluent customers who might otherwise take their business to a specialist firm. This is about capturing more of the customer's wallet and building deeper, more profitable relationships. From this viewpoint, the initial share price drop is just short-term noise. Investors are notoriously skittish about large acquisitions. But in the long run, the strategic logic will win out, creating a more valuable and diversified financial group. Now, let's examine the bearish counter-argument, which seems to be the prevailing sentiment in the market today. The skeptics see multiple red flags. First, the price. At £2.7 billion, this is a huge bet. NatWest is still partially owned by the UK government following its bailout during the 2008 financial crisis. Using such a large sum of money for an acquisition, rather than returning it to shareholders via dividends or buybacks, is a bold and potentially risky choice. Second, integration risk. Merging two large, complex organizations is notoriously difficult. Clashing cultures, incompatible technology systems, and client attrition are common pitfalls. The promised synergies, the cost savings and revenue boosts that justify the premium price, often fail to materialize fully. Third, and perhaps most importantly, the timing and the motive. Why now? Is NatWest making this move from a position of strength or one of weakness? Let's look at some key statistics that paint a picture of the bank's current standing. The bank's total market valuation took a significant hit this morning. But beyond the immediate reaction, we need to consider its core financial health. For instance, the bank's common equity Tier 1 ratio, a key measure of financial strength, will be impacted by this cash and shares deal. Furthermore, the return on equity they expect from this wealth management business will need to be substantially higher than their current returns to justify the investment. The market is effectively saying, prove it. They doubt that the growth potential in the crowded UK wealth management sector is as significant as CEO Thwaite claims. They worry this is a costly attempt to buy a narrative of growth, rather than a disciplined capital allocation decision. To visualize the scale of this transaction and its immediate impact, let's put some numbers on screen. The deal value of £2.7 billion, or $3.7 billion, is a monumental sum. Compare that to the immediate market reaction, a 4% drop in NatWest's share price. That percentage might seem small, but for a bank of NatWest's size, it represents billions in evaporated market capitalization in a single morning. This stark contrast between the money spent and the value destroyed, at least initially, is at the heart of today's drama. Now, let's broaden our lens beyond the City of London. What does this NatWest saga tell us about global banking trends, and why should viewers in Nairobi, Mombasa, or Kisumu care? The pressures facing NatWest are not unique. Banks worldwide, including here in Africa, are grappling with similar challenges: low interest margins, competition from agile fintech startups, and the need to find new sources of profit. The pivot to wealth management and premium services is a global theme. We see it with Standard Chartered, with ABSA, and with other Pan-African banks. They are all chasing the continent's growing number of high-net-worth individuals. The strategy is clear: serve the mass market with digital platforms, but dedicate high-touch, personalized service to the wealthy elite who generate disproportionate fees. However, the NatWest story serves as a cautionary tale. Acquisitions in this space are expensive and risky. The integration of culture and client books is delicate. A misstep can destroy shareholder value rather than create it. For Kenyan banks eyeing regional expansion or new business lines, the lesson is to be meticulous. Growth must be strategic, not just for growth's sake. Paying a premium for assets requires crystal clear confidence in your ability to integrate them and extract value. Let's connect this to an even more profound issue, one that touches on the very purpose of finance. While NatWest debates spending billions to manage the wealth of the rich, we are reminded of the stark inequalities that persist globally. Our third research source, though not directly about banking, offers a poignant contrast. It details the work of a Nigerian couple fighting the horrific practice of infanticide in isolated communities where babies are deemed bad omens. This story of protecting the most vulnerable exists in a different universe from the boardroom discussions about wealth management fees. Yet it forces us to ask, what is the financial sector's role in bridging these worlds? Can the immense capital and expertise deployed in deals like NatWest's also be channeled towards inclusive finance, social impact investing, and supporting entrepreneurs who solve critical social problems? This isn't just a philosophical question. It's a business imperative. The long-term stability and prosperity that create wealth management clients are built on inclusive, equitable societies. Banks that ignore their social license to operate do so at their peril. Returning to our core analysis, we must also consider the political and regulatory environment. NatWest is no ordinary bank. It's a symbol. It was at the center of the 2008 financial crisis and subsequent bailout. The UK government still owns a significant stake. Therefore, this acquisition will be scrutinized not just by investors, but by politicians and the public. Is this a responsible use of resources? Does it benefit the broader economy, or just a segment of wealthy clients? These questions will echo in Parliament. In Kenya, we understand this dynamic well. Banking is a sector of strategic importance, often under the watchful eye of the Central Bank of Kenya and the National Treasury. Major moves by our large banks are seen through a dual lens: shareholder value and national economic impact. The debate around consolidation, lending to SMEs versus large corporations, and investment in flashy headquarters versus rural branches is ever present. The NatWest deal is a high-profile example of a bank choosing to allocate capital towards the premium end of the market. That choice is being judged, and harshly, by the market's cold calculus. As we move into the final segment of our deep dive, let's project forward. What are the possible outcomes of this NatWest gamble? Scenario 1: the integration is a success. The cross-selling works beautifully. The wealth management business grows steadily, and its high-margin fees boost NatWest's overall profitability. Within 2 to 3 years, the initial share price drop is forgotten, and the deal is hailed as a masterstroke. CEO Paul Thwaite is vindicated. Scenario 2: the integration is messy. Key client teams leave, taking clients with them. Technology integration costs balloon. The expected revenue synergies fail to materialize. NatWest is left with a costly acquisition that dilutes returns and becomes a millstone around its neck. The share price continues to underperform and pressure mounts on management. Scenario 3: a middle path. The deal is neither a disaster nor a triumph. It adds some diversification, but at a high cost. NatWest becomes a slightly different, slightly larger bank, but the fundamental challenges of competing in a digital age remain. The market's initial skepticism proves partly right, and the bank's valuation remains subdued. For investors, employees, and customers, the coming months will be telling. The first earnings calls after the deal closes will be dissected for any signs of strain or success. Client retention figures in the wealth management unit will be a key metric to watch. And for other banks around the world, including here in Africa, this will be a live case study in the perils and potential of transformational M&A. In conclusion, the 4% drop in NatWest's share price is more than just a daily market fluctuation. It is a verdict. It is the collective judgment of thousands of investors expressing doubt about a £2.7 billion strategic bet. It highlights the intense pressure on traditional banks to reinvent themselves and the severe punishment the market metes out for moves it perceives as risky or expensive. From the trading floors of London to the banking halls of Nairobi, the message is clear. In today's financial world, growth must be credible, disciplined, and create unmistakable value. Expensive acquisitions bought with shareholder money come with no guarantee of success, only the certainty of intense scrutiny. The story of NatWest's costly pivot is still being written, but its first chapter has been marked by a loud and clear note of investor dissent. Thank you for joining us for this comprehensive analysis. Remember to think critically about the flow of capital, the strategies of institutions, and the broader impact on our societies. Subscribe to Kenya News Update today for more deep dives into the stories shaping our world and our economy. Good night.